Good morning students, I welcome you all for the online class of economics. Today we will be going to learn the structure of government budget. Revenue receipt we started in that, capital receipt we have to start, but revenue receipt we have just completed what the things are there. Once again I want to recall you what the things are coming in revenue receipt. Revenue receipt student, these receipts do not create any type of corresponding liability over the government, and second thing, this will not reduce the assets of the government. That type of entries which are coming, that type of transaction which is coming to the government, it is known as revenue receipt. The revenue receipts of the government thus can be defined as those money received which do not create a liability for the government and as well do not lead to reduction in assets of the government is known as revenue receipt. Is borrowing by the government a revenue receipt? The answer is no, because it creates a liability for the government of repayment. Revenue receipts are further classified as tax receipt and non-tax receipt as detailed in the following chart. Constituents of revenue receipts, when we see, there are two constituents of revenue receipt. One is tax receipt and another is non-tax receipt. We have already learned this: income tax, corporation tax, estate duty, everything. Non-tax receipt, I said that today I will be going to start. Let us start non-tax receipt from there. Non-tax receipt, when we come students, here before that I want to give one question. State the basic difference between direct and indirect taxation. Give an example. What is the difference between direct and indirect tax? First of all, direct tax is directly charged from the particular person who is earning the income. So it is a direct tax. Indirect tax, when we say, like sales tax, it is charged on the seller, but it is taken from the consumer of the goods. So it is not paid by the seller, but it is indirectly taken from the consumer and paid by the seller of the goods. So it is known as indirect tax. While the impact of indirect taxation like sales tax can be shifted onto others, the impact of direct taxation cannot be shifted to others. Example, a shopkeeper pays sales tax to the government but usually recovers it from the consumer as part of the price of the commodity sold. So, impact of sales tax and indirect tax is ultimately shifted to the consumer, but impact of income tax is to be finally borne by the taxpayer himself. He cannot shift its burden onto others. Non-tax receipt, when we say, non-tax receipts are those receipts which arises from sources other than taxes. Some of the non-tax receipts are as follows. Very first, fees. A fee is a payment to the government for the services that it renders to the people. Example, land registration fees, birth and death registration fees, passport fees, court fees, etc. It is to be noted that fees is not a payment price for commercial service. It is a payment for administrative and judicial services provided to the people. Fines, when we talk, fines are those payments which are made by the law breakers to the government. These are economic punishment for breaking law. The aim is not to earn revenue but to make people respectful to the law. That are the fine. As cheat. Some people leave property without a legal hire. That time that property goes to the government. The government makes revenue out of it. It's called as cheat. Special assessment. Special assessment is that payment which is made by the owners of those properties whose value has appreciated due to development activities of the government. For example, as a result of construction of roads or provision of sewerage system, value of the neighboring property may appreciate. The government may recover a part of its development expenditure from the owners of such property by way of special assessment. Right, roadside. When industrialization is done, the property, the value of the nearby land also increase. So that time government will charge some of the tax over that, will earn some of the income from that special assessment of the value of the piece of land. That is known as special assessment. Income from public enterprises. Several enterprises are owned by the government. Example, Indian Railways, Nangal Fertilizer Factory, Indian Oil, Bhilai Steel Plant, etc. Profit of these enterprises are a source of revenue for the government. So income from public enterprises can be owned by this way. That is also income of the government. Income from sales of spectrum like 2G and 3G. There are various spectrums taking place. Income from that, the sale of spectrum has significant source of non-tax receipts of the government. Grants, donations. Grants are also a source of government revenue. It is very common for the people to offer donations and grants to the government. when there are natural calamities like earthquake, flood, etc., famines, etc. So that is also a source of income from the government, from which they make the development of the society. So these are the non-tax receipt, because this thing we are not getting any receipt from government of India. Capital receipts. All such money receipts of the government are classified as capital receipt, which show the following two characteristics. Very first, the receipt which will create liability on the government, for the government. For example, loans by the government are a liability. They are to be paid back. These are therefore the capital receipts of the government. Second, this receipt makes loss of the asset, reduction in assets of the government. As stated earlier, money received by the government by selling its shares, say of Maruti Udyog, causes reduction in assets of the government. These are therefore to be treated as capital receipts. Capital receipt thus can be said those money receipts of the government which create liability for the government and also causes reduction in the assets of the government. It is known as capital receipt. These two impact, if we will see in any transaction, then definitely it will be coming in capital receipts. Now comes in India, capital receipts of the government budget are often classified as under. Very first, capital receipt, recovery of loans, borrowings and other liabilities, other receipts. Recovery of loans. The central government offers loan to the state government to cope with emergent situations. When these loans are recovered, assets of the government are reduced. Accordingly, these are classified as capital receipts. Borrowings and other liabilities. The government borrows money from the general public. Borrowing from the general public are called market borrowings. The Reserve Bank of India, the rest of the world. While lending creates asset, borrowing creates liability. Accordingly, borrowings are to be treated as capital receipts. Other receipts, when we say student, these include items like disinvestment. It is the opposite of investment. When government make disinvestment in some of the projects in which they don't want to continue, like government when sell off their shares from some of the industry, then it is known as disinvestment. They will definitely sell it to the private sector, not to the other government sector. It involves transfer of ownership of public sector enterprise to the private enterprise, briefly called privatization. Money received through disinvestment is treated as capital receipt because it causes reduction in assets of the government. What is disinvestment? Does it refer to revenue receipt or capital receipt of the government? Give an example. Disinvestment refers to withdrawal of existing investment in the company. When the government don't want to continue its investment in the specified field, then they sell of the shares to the private sector. It is known as disinvestment. Example, the government of India is undertaking disinvestment by selling its shares in the Maruti Udyog. It is a capital receipt of the government as it reduces the assets of the government, as Maruti Udyog company had been reduced from the number of firms of the government. Budget expenditure, student. What do you mean by budget expenditure? All this expenditure refers to estimated expenditure of the government relating to its development as well as non-development programs during the fiscal year. Like receipts, all the expenditure of the government is broadly classified as revenue expenditure and capital expenditure. When we talk about revenue expenditure by the government showing the following two characteristics is treated as revenue expenditure. Very first, it does not create any asset for the government. Second, for example, expenditure by government on old age pension. It will not create any asset for the government, as this expenditure is generally done for charity purpose. Salary and scholarship to the students are to be treated as revenue expenditure because this does not lead to any type of asset formation of the government. It does not cause any reduction in liability of the government. Expenditure by the way of grants to the state government to cope with natural calamities like floods and earthquakes, like this pandemic situation which arises now, does not reduce the financial asset liability of the central government in any manner. Accordingly, this is to be treated as revenue expenditure. So, in short, revenue expenditure refers to estimated expenditure of the government in a fiscal year which does not create any liability assets or cause a reduction in liabilities. Is known as revenue expenditure. Important items of revenue expenditure in the Indian government budget are, these are as under: wage bill of the government, interest payment, expenditure on subsidies, defense purchases, likewise. This item will be considered as revenue expenditure. As a matter of convention, all grants by the center to the state government and the government of union territories are treated as revenue expenditure, even when some grants may result in the creation of assets. Now the fourth term, capital expenditure. What is capital expenditure, student? Expenditure by the government showing the following two characteristics is classified as capital expenditure. It creates asset for the government. Equity or share of the domestic or multinational corporation purchased by the government may be cited as an example. It causes reduction in liabilities of the government. Repayment of loans certainly reduces liability of the government. Accordingly, this is to be treated as capital expenditure. In short, capital expenditure refers to the estimated expenditure of the government in a fiscal year which create assets or causes a reduction in the liabilities of the government. That all expenditure is considered as capital expenditure. Important items of capital expenditure in the Indian government budget are, these are as under: expenditure on land and building, expenditure on machinery and equipment, purchase of shares, loan by the central government to the state government or state corporation. These important terms will be coming in capital expenditure in the Indian government budget. Plan and non-plan expenditure. Very simple term. When we are doing some expenditure and it is planned from the beginning, how much we will be doing expense, it is known as planned expenditure. Sometimes suddenly some expenditure comes to us and we have to make it. That is non-plan expenditure. For that we never make the planning. So let us read from the book point. Public expenditure, revenue expenditure plus capital expenditure, is also classified as plan and non-plan expenditure. Following is the difference. Very first, plan expenditure. Plan expenditure refers to that expenditure which relates to the specified plans and programs of development or assistance of the central government to the state governments. It includes both revenue expenditure like payment of salaries and capital expenditure like construction of a hospital building. However, once a particular project related to a specified plan is completed, plan expenditure of the government on that project is taken to be as over. Example, expenditure by the government on the construction of a hospital building will be taken as planned expenditure only so long as the hospital project is not completed. Once the project is completed, any subsequent expenditure related to maintenance of the hospital will not be categorized as planned expenditure. It will be deemed as non-planned expenditure. Non-plan expenditure refers to the expenditure which is not related to specified plans and programs of the development as well as non-related to assistance of the central government to state government. Like planned expenditure, non-plan expenditure also includes revenue as well as capital expenditure. Broadly classified as any expenditure other than plan expenditure is considered as non-plan expenditure. Expenditure on defense and subsidies. Sometimes it has to be made suddenly. It is considered as non-plan expenditure. Salaries and pensions are notable examples on non-plan expenditure. In India, non-plan expenditure is a significant part of the total government expenditure, which is why fiscal discipline in the country often remains a serious challenge. Thus, total government expenditure equals to revenue expenditure plus capital expenditure, or total government expenditure equals to plan expenditure plus non-plan expenditure. This is known as government expenditure. Structure, make a screenshot, it will be good for you as to understand. For today's class, this much only I will be explaining. Make a structure, make the meaning of each topic. This meaning, if you will write, this chapter as it is very important. If the meaning is clear, you can explain it very nicely. There are 3 formulas as well as the structure is given. Please make a screenshot and make the notes of this. In the further class, I will be explaining the formulas related to budget deficit and primary deficit, and then I will be telling some of the calculation. Thank you for today's class. Have a nice day.